Hello and welcome to revision tips for CIPS Level 5 Advanced Diploma in Procurement and Supply. This is Module 2, which is Managing Supply Chain Risk, and I'm going to look at Learning Outcome 1, which is to understand and analyse the nature of risk affecting supply chains. So we're going to start off with what a definition of a risk is. Essentially, a risk is something that might not happen, but if it did, it would have an impact on the achievement of something, such as a successful supply chain. The thing which might happen is known as a risk event, and the thing that might create the event is known as a hazard, such as a supplier failing to do their obligations. And risk is an effect of uncertainty and the effect it might have on what your organisation is trying to achieve. The effects themselves of a risk can be positive or negative. Now, risk appetite is another aspect of risk management. It illustrates the extent to which an organisation is concerned about its risks. A risk enthusiast means that such an organisation is not worried about risks. And a risk-averse company is when an organisation will do anything it can to identify risks and prevent them from happening. The appetite can be viewed at three distinct levels within an organisation. At corporate risk, which is the amount of risk judged appropriately at the strategic level, so very, very high up. You've got delegated risk appetite, which is agreed corporate appetite that's cascaded down the organisation. And this places boundaries of discretion on business units and functions, beyond which risk may or may not be accepted without the reference upwards. And then project risk appetite. This relates to a specific activity that the organisation may be undertaking. So you could have a very risk-averse corporate and delegated risk appetite, but on a particular project, you might want to think nothing ventured, nothing gained. But as no venture is without any risk, there is a balance to be struck by an organisation between how much risk it's willing to accept against the potential reward. This 2x2 matrix illustrates the decision-making process, balancing risk and reward to decide if you should progress, consider or avoid something. Now, data, judgment and assessment will be needed by an organisation in considering how much risk and reward is inherent with any activity it undertakes. So low risk, low reward, consider these risks. They're considered low in terms of impact and likelihood, but as well as that, the rewards are likely to be low too. So this is likely to fit well with the risk appetite of most organisations, but may result in the use of resources that could be used more productively elsewhere. High risk, low reward, avoid those. They're assessed as having high risk impact, but the rewards and likelihood of success are really low. So an example is accepting a lower quality product from a supplier to make short-term savings, resulting in increased customer dissatisfaction. Low risk, high reward, progress this one. Risks are assessed as having a low impact but high reward. These risks are clearly worth taking. So an example is adopting a substitute product that's been tested by others in the marketplace. High risk, high reward, consider these risks. They're assessed as having a high impact, high likelihood, but with high rewards. So for example, investing in an electronic data interchange technology to soften the boundaries across the supply chain. Real-time stock data will decrease stock holding and reduce waste across the whole supply chain, as well as improving communication. But it will leave you vulnerable to information loss, and it will create dependencies on your suppliers, which could lead to complacency. Although a risk event may create opportunities for an organisation, generally risk management is concerned with avoiding losses. And there are two types of losses that need to be considered. Direct loss is attributed directly to the event itself, whereas an indirect loss is something that arises as a consequence of the loss. So if an organisation's IT systems was hacked, it might not be a direct loss unless money was stolen. but it could be a significant impact on the reputation of an organisation if that was made public or if customers lost money from a breach of security. So the organisation might find itself liable for losses incurred by a customer, and this is known as an indirect loss. There are a variety of risks that an organisation could face. So before looking at some of the tools to help identify those risks, we start by looking at the broad categories which an organisation might face. These 4 areas are considered to be standard areas in which risk may be found. So financial risks, these are risks associated with financial loss, like the loss of sales as a result of reputational damage. Negative exchange rate impacts. Then we've got strategic risks. These are risks associated with organisational strategy or risks that affect the organisation at a strategic level, lower than projected sales or new market competitor that's limiting your growth. Organisational or operational risks, these impede or have an impact on your business operations. So examples could be machinery breakdowns, excessive employee sickness, etc. And hazard risks, these need to be actively avoided or mitigated, such as lone workers in unsafe conditions or working at height. Each of these categories need to be considered in order to identify the risks, to allocate responsibility for them. And large organisations are likely to have an internal specialist who is responsible for each category, so in accounts or operations. So risks can arise from internal or external sources, which an organisation could encounter. And here are some of the internal ones. Human personality factors, cultural values and norms or group dynamics, human error or inexperience, business management or lack of it, malicious activity, a breakdown of technology, equipment or systems, security risks, lack of internal controls and workplace hazards, poor employee relationships, and a loss of key personnel and knowledge. Now this slide focuses on the previous one, but provides a list of external sources of risks. Note that it's based on traditional external environmental analysis tools like PESTLE or Steepled, which covers more areas, and Porter's 5 forces. So yes, if we use the steepled list for the macro environment, this would have us looking at things like sociological, technological, economic, environmental, political, legal, ethical, and demographics. Whereas in the Porter's forces model, we're looking at the micro environment, which is the threat of new entrants, the threat of substitutes, and whether or not the power is with the buyer or supplier. Another potential area of risk which can arise from the contracts. So the external and internal risks can be considered as general organisational risk areas which may have an impact on the work of procurement. But contract failure is a particular relevant area for procurement as the work we do leads to contracts. And we're often responsible for undertaking the contract management role. So this illustrates the importance of good contract development and management together with supplier management. So this could arise from a contract not meeting needs or one party failing to meet their obligations, such as non-performance, the nature of the risk and the potential scale. And these can be influenced by the nature of the risks, i.e., how much risk is inherent because of the market conditions and situation, the value. Smaller contracts usually have less financial impact. Duration and scope, the lengthier contracts covering larger areas have more aspects that could go wrong. Skills level required, this can increase the risk of non-performance and also introduces quality risks. Criticality contracts, they're viewed as significant to the organisation's operations and they can carry greater importance, but may also have more time and attention spent on managing them. Another general area of risk which might have particular relevance to the work of procurement is financial risk, as money is often something that we're responsible for. And they arise from international trade because we have currency exchange rate fluctuations or issues with the suppliers. Now, you can mitigate currency risks involved in setting exchange rates in advance or eliminating the danger by buying the local currency. Supplier risks can result from an experience of cash flow problems, which means they won't be able to fulfill their obligations, or ultimately they may become insolvent. But both of these create an issue for the buyer if they're reliant on that supplier for large volumes of critical supplies. It may also be an issue where the buyer has invested in a seller from a supplier relationships perspective. It may also create issues of continuity of supply for the buying organisation. Areas of financial risk can also create issues for continuity of supply. So we're now going to look at some of the risks connected with this. Efficient operations assume that the supply chain will function as expected and deliver what's required and when required in the right quantities to the right place. But continuity of supply relates to whether or not an organisation can rely on it happening or not. The more lengthy, complex, sophisticated, time-consuming or multi-layered the supply chain is, the greater the degree of risk that will be introduced. Supply risks relate to an organisation's supplier being unable to supply at all, or supplying goods of inadequate quality, or not being able to ensure continuity of supply. So let's now consider the issue of supplier cash flow. Suppliers' staff and overhead costs often need to be paid on an almost immediate basis, but customers take up to 90 days or more to make their payments. Now, without careful cash flow management, this can put put the supplying organisation at risk of entering liquidation. And that would mean the buying organisation has to resource the products of vital services or agree a financial rescue package which brings a fresh set of risks to be managed. To reduce the risk of a supplier experiencing cash flow problems, a buyer should agree fair payment terms, dealing with invoice queries promptly and making payments on time. Now, insolvency is when an organisation is unable to raise enough cash to meet its obligations or to pay its debt when they become due for payment. And the reasons for insolvency include the loss of a major customer. So it is important for a buying organisation to understand how reliant a customer is on their, how reliant a supplier is on their customers. You've got the loss of key employees. So certain employees, like key account managers, are pivotal to organisational success. In some situations, employees may leave en masse to go to a competitor. Fraudulent activity. In the case of major fraud, your organisation can be left without enough cash to pay its creditors. And large fines. US chip manufacturer Qualcomm was fined $1.2 billion by European regulators following claims of uncompetitive behaviour. And they're large enough to weather this fine, but for smaller organisations, fines like this could prove catastrophic. Excessive or uncontrolled expenses. This could be as a result of incomplete or poorly judged business cases, or simply a lack of financial control. Uncontrolled growth. Growth must be funded and planned. Cash will very quickly run out when fueling high levels of growth. And late payments. Delays in payments from buying organisations can lead to insolvency. So as part of due diligence and ongoing monitoring of risk, buying organisation may want to conduct reviews, such as those that you can see on the screen. The degree of which this is feasible and possible will depend on the nature or relationship of the contract. So may be more aspirational than realistic, but many of the signs can still be watched for and actions taken as you seem appropriate. Now, the buying organisation should assess the supplier's financial position before awarding a contract and monitor it through the life of the contract in order to identify risks early so they can be mitigated. And to understand a supplier's financial situation, your organisation should focus on a number of factors, such as profit and financial ratios. How much profit is the supplier making? Is it rising or a declining trend? How does this stack up against other players in the same industry? Are there any reasons for this pattern? Gearing, which is a means of seeing how much somebody has borrowed money versus stock holding. And a highly geared company is one with a high proportion of long-term debt. This means that any cash an organisation has will need to be serving interest to pay off that debt, leaving it less able to weather difficult times. And cash flow, are the suppliers able to meet their short-term debts and manage cash flow? Credit agencies are able to offer insights and reports which may help you to judge. Now, quality is one of the 5 rights of procurement, but from a risk perspective, it can affect the organisation in 2 ways. Firstly, it relates to the quality of the product and service purchased by an organisation, and that will influence the degree to which it checks the quality and inputs it requires. Secondly, it relates to the quality of the outputs produced by your organisation. Whilst this may be a function of operations, it may also be a function of the quality of the inputs or the materials required or acquired by procurement to help operations to do their job, such as indirect purchases. So checking can take place in 2 ways: assessing the quality of the items themselves and building processes that help to ensure higher quality to begin with, thus ensuring there are fewer quality issues. And sometimes it can be more cost effective to check and put right rather than building systems which stop the problem from occurring. Now, defects in quality will have an impact in terms of reputation and reworks, so a fundamental decision is to be made between checking to identify problems or building processes that prevent them. The cost of failure refers to losses incurred due to poor quality products entering production or reaching the customer. And they can be internal failure costs on the left-hand side, such as reworks, scrapping, inspections, downgrading, waste, or holding contingency stock. And then the external failure costs, such as reverse logistics through returns, repairing, replacing, and customer compensation and the admin costs, as well as the impact on customer loyalty and retention. So they can be balanced against the costs of good quality on the right-hand side. Appraisal cost, this is quality assurance. This is linked to quality and about getting it right first time. So prevention cost is quality assurance. Appraisal cost is quality control. So appraisal is checking the outputs. Prevention is putting in place some systems that aims for 0 defects. Now, counterfeit goods are often a result of quality failure. Producers are more likely to take shortcuts and less likely to have required quality assurance standards in place. Now, quality failure is a critical issue for the majority of organisations, no matter whether the organisation is profit-focused or a public or a third sector. Satisfying and exceeding customer expectations is a key driver for the achievement of aims and objectives, and failure to satisfy the customer and end user will result in higher levels of internal cost, as a result of activities such as returns and reworks. And consequential losses, such as reputational impact, may be experienced. So auditable and certifiable quality management standards like ISO 9001 help to make sure that customers get consistent high quality products and services, which in turn bring many business benefits. The aim of ISO 9001 is to help businesses and organisations to be more efficient and improve customer satisfaction. It's based on the principle of continuous improvement, and it encourages organisations to see quality from the viewpoint of the customer, and it works back from that point. After all, if processes are not adding value for the customer, what is their purpose? So ISO advises that the approach ensures repeat business and enhanced reputation. If the customer experiences poor quality, then the opposite is true. So by adopting this standard, risks can be reduced and organisations are encouraged to meet statutory and regulatory requirements. This ISO encourages the use of Deming's Plan, Do, Check, Act cycle. So what is the point in checking it if you're not going to do something about it? So this model, known as Deming's cycle, illustrates the 4 steps involved in quality improvements. So first of all, the activities are undertaken and they need to be planned. So working out what the organisation might do. Then it needs to be implemented, but with measurement systems so the degree of improvements can be assessed. And then checked to see whether it's worked or not. Finally, if the improvement was a test or a pilot, then it needs to be implemented throughout the organisation. And it should be seen as cyclical rather than a linear approach. After an improvement has been implemented, you can continue to pursue other improvements using the new approach and generating a culture of continuous improvement. Outsourcing can provide the business with a number of benefits, but it is an inherently risky decision due to the consequences for the business if the supplier fails to deliver. The actual risks encountered during an outsourcing activity will depend on the specifics of the activity. But this slide presents a general indication of the areas in which risks may be encountered, such as the loss of control and expertise in what may be a key area for the organisation, or poor performance or increased costs. The next area of risk we'll look at is fraud, bribery and corruption. Now, fraud in its various guises is more likely with groups where we have low morale or are demotivated. So management style and motivations are important in avoiding it. In addition, inadequate prevention and detection controls effectively allow people to commit fraud by creating the conditions in which it can happen. Now, it's not just the removal or theft of funds or assets from an organisation. It can include fraudulent expense claims, fake invoicing, counterfeiting and misuse of intellectual property. It can also involve intentional misrepresentation of the financial position of a business in order to mislead shareholders, tax authorities or regulatory bodies. Now, in addition to this, the corporate fraud, for which there are statutory remedies, organisations or individuals may misrepresent themselves to customers and potential customers in a way such as their capabilities or capacity. And bribery is the promise of giving or receiving of financial or other benefits to induce or reward improper performance. Collusion is the cooperation of parties in order to carry out fraudulent activity, and corruption is the misuse of resources or power for private gain. Now, types of fraud organisations might deal with include procurement fraud. This involves collusion with suppliers on pricing in return for a kickback or processing false claims. Procurement staff are stewards of the organisation's funds, and as such, they're trusted with and have access to large sums of money. Bribery, this could be part of procurement fraud or could involve any officer of the business who gives or receives money in order to induce or influence a favourable decision. This is covered in the CIPS Code of Ethics, which you should read. Assets. There is a risk of theft or misuse of assets, minor losses such as stationery theft to large-scale inventory theft, such as redirecting a container full of imported items. Intellectual property fraud might involve copying of brand names or stealing designs. There are well-published cases of this. IP fraud can create hazard risks as well as financial ones. So examples include 3M Litterman, who's identified that there's many counterfeit stethoscopes that have entered the supply chain, which may result in compromised clinical diagnosis. Counterfeiting. This is where you use intellectual property and you're counterfeiting money because you are trying to make money that doesn't exist, essentially. Counterfeiting goods also would involve that sort of intellectual property, sort of pretending that it's something that it isn't. Identity fraud and theft is unfortunately very common. Examples will include companies placing large orders that will never be paid for. And CEO fraud, the impersonation of a senior company executive to divert payments for goods or services into a fraudulent bank account. Publishing of incorrect financial statements. This can be in tax avoidance or perhaps in attempt to seem more financially stable to potential buyers. Buying organisations rely on these financial statements to understand rough cut capability fits, stability and negotiation targets. So this practice can lead to major supply chain difficulties. Falsification of expense claims. Expenses are part of our organisation's overheads, deducted straight from the bottom line, with a direct impact on profit. So if each employee submits a false receipts, the impact on profitability could be devastating. So the organisation experiencing the fraud would have two options: take reduced profits or increase pricing. Here we look at some of the types of bribery and fraud that organisations may experience, such as those to secure a contract in order to gain an advantage over a competitor, or falsify documentation, or to turn a blind eye to something such as health and safety issues, or poor performance, or substitutions of materials, or even false accounting practices. Now, ethical trading can influence the approach that may be taken when sourcing. And the idea of ethical trading can impact at three levels: macro, where there is a social impact on ethical trading, such as avoidance of child labour and anti-slavery regulations. At corporate level, organisations set policies and approaches to ethical trading that impacts their own operation. And at individual level, influences such as attitudes to bribery also have an impact. There are professional codes of conduct that guide behaviour for both individuals and, to an extent, the organisations they work for. Which leads me nicely onto the CIPS Code of Conduct. This Code of Conduct for procurement enables members to have a code which they can be proud to have adopted. So members must disclose any personal interests, respect confidentiality of information, avoid any arrangements which seem unfair or prevent competition, and except for low-value items, business gifts shouldn't be accepted. Only modest hospitality should be accepted. And any doubt on these last 2 points should be discussed with the individual superior. There's also a code of ethics which organisations can use to adopt on their own. Now, although Sarbanes-Oxley is specifically for US companies operating in the USA, its influence reached globally, particularly with large US companies such as Apple, Microsoft, and so on. And adherence to Sarbanes-Oxley guidelines are frequently a requirement of US companies when sourcing potential suppliers. Now, corporate governance is the systems by which organisations are directed and controlled. The UK system was developed and formalised from a range of reports and recommendations, including the Cadbury, Greenbury and Hempel reports. The recommendation of these three reports were merged into a combined code in 1998, which, with companies listed on the London Stock Exchange, are required to comply with. And the Turnbull report in 1999 focused on the internal controls and risk management, and this was revised in 2005. But the USA's Sarbanes-Oxley Act followed a number of damaging corporate scandals and contains extensive requirements aimed at preventing conflicts of interest, assuring the integrity of internal controls, and enhancing transparency in corporate financial matters. It has considerable influence outside of the USA, and as a model in the area, is generally the standard for all companies with global operations. Now, the various laws and requirements around governance have led to the following requirements for private companies with UK stock market listings. This is illustrated as one of the key principles of governance, which is the separation of duties between different parties and functions. This reduces the chances of collusion and provides a measure for check-in to help reduce the opportunities for fraud or other unethical practices. But it also helps with robustness and processes, as there is an outside party which can provide audit and check-in function. So the recommendation to raise your standards is there should be clear division of responsibility at the top. The majority of board should comprise outside directors. Remuneration committees for board members should make up the majority of non-executive directors. And the board should appoint an audit committee, including at least 3 non-exec directors. Now, this slide introduces you to the International Labour Organization, the ILO. This is the United Nations specialist agency promoting human, civil, and labour rights. These may impact on procurement, as the recommendation is that the buyer should purchase from suppliers that conform with these standards, so they maintain a strong ethical position from a labour practice perspective. Now, the ILO is aiming to bring together governments of its member states in order to set labour standards, develop the policies, and devise ways of promoting decent work for all. So as part of the purpose, the ILO states that its decent work agenda helps the economic and working conditions that give all workers, employers, and governments a stake in lasting peace, prosperity, and progress. The 4 strategic objectives at the heart of the decent work agenda are set and promote standards and fundamental principles and rights at work, create greater opportunities for women and men to gain decent employment and income, strengthen tripartism, that's contracts for business, labour and state affiliations within the economy, and social dialogue, and enhance the coverage of effectiveness of social protection for all. The ILO also does fully support the Sustainable Development Goals of the United Nations, and it recognised the impacts of influencing large organisations on practice within supply chains, encouraging the practices of member states, passing disclosure legislation to ensure that organisations understand and report on their progress. John Elkington strove to measure sustainability during the mid-1990s by encompassing a new framework to measure performance in corporate America. This accounting framework is called the triple bottom line because it goes beyond the traditional measures of profit, return on investment, and shareholder value to include environmental and social dimensions. By focusing on a wider range of performance issues, it considers the impact on people and the planet, as well as the profits. It can support the development and achievement of sustainability goals. So the triple bottom line is often known as the 3 Ps: people, planet, profit. Now, the ETI is an alliance of companies, non-government organisations and trade unions committed to working together to identify and promote internationally agreed principles of ethical trade and employment. And they have to monitor the observation of codes of ethics. Working with suppliers that have signed up to the initiative, they try to help reduce some of the risks that might have been experienced from supply chains, as well as aid in the delivery of any ethical or corporate responsibility. And that's based on their objectives or goals, any of those that the organisation may have. But the ETI has a base code, so it talks about employment must be freely chosen, child labour mustn't be used, and no discrimination practiced. It mentions freedom of association and the right to collective bargaining, which is the ability to join a union and have them speak on your behalf. Living wages are paid, regular employment provided. Working conditions need to be safe and hygienic, and hours mustn't be excessive. And absolutely no harsh or inhumane treatment is allowed. Organisations can also use accreditation such as those from the International Standards Organisation. And this is to assess and mitigate their risks both within the procurement function and the wider supply chain. So there's quite a few examples on the screen right now. I'm just going to tell you what each of these are. So ISO 31000 is risk management, provides universal principles and generic guidelines applicable to any private or public organisation or a community enterprise, but it includes principles, frameworks and processes all about risk. 14001 is the standards for environmental issues. 26,000 is a social responsibility standard. That's got clear principles on social responsibilities covering areas such as governance, labour practices and human rights. And finally, 2400. This is sustainable procurement standard, and it's got guidance on how to integrate sustainability within procurement, but certification is not available, it's only for guidance. That's the end of Learning Outcome 1. Thank you for watching.